conference and we'll launch to get the name out to our following quickly. And we covered DXPE a while back. I mean, we've been around 20 some odd years, and we covered, it had to be 15 years ago at least.
Okay.
It was like 22 a share.
Yeah.
Did it split? I don't think so.
Well, my predecessors, I think they did. I don't know if they did. I think
Mac
they did.
McCollum, right?
Yeah.
He came to our conference too.
Yeah. No, Mac's a good guy.
Yeah. And David Little.
Yeah.
I think it was just Mac. I didn't think David came out.
He never came. Yeah.
Man behind the curtain.
Yeah. He's still there.
Yeah.
He's still there.
You guys are doing a great job, and I wish I never sold the share out. It's a mistake, my biggest mistake. I'll introduce you. Get rocking here. So I think all you need to do is flip that guy.
Okay.
And your mic's here. It's going to record. It's recording now. And I got to turn this on. Okay, welcome back, my friends, to our ongoing conference, and we're kicking off the second half with a larger company for us that's been very successful, and to us very de-risked, and a steady, stable performer. A company that is based in Houston, Texas. It's called DXP Enterprises. And what does that DXP stand for?
Distribution experts.
Okay, that makes sense. I cracked the code on that one. So just a little bit, the company distributes maintenance, repair, and operating supplies, rotating equipment, safety products, and engineered solutions, and operates in 3 segments, industrial segments, I trust, and has been very successful with acquisitions.
Yes.
And there are many more out there.
Yes.
And since they're very successful at that, they are able to grow without needing Wall Street very much, if at all, really. And to us, that's a good thing because they don't need to sell stock. They just keep growing those, earnings on the same share base. So we are fortunate to have the CFO of DXP Enterprises, Kent Yee, with us to take us through the presentation. Welcome, Kent.
Thank you, Robert. Thank you, Robert. Yeah. And I think, is this mic on? I'm going to use that mic.
Yeah, I'll turn that one off. It should be on. Test.
Can everybody hear me?
No.
Oh, okay.
Is the green lights on?
Yeah. Hello.
I'll go get the guy.
Hello. There we go.
Oh, there it is. Hello.
There we go. So DXP Enterprises, we're known as a B2B distributor. We go to market under 3 business segments: service centers, innovative pumping solutions, and supply chain services. Service centers is roughly 65-70% of what we do. The way to think about that, and I have some slides later on that I'll go into a deep dive, is a local presence in a local market, and we service it through an inside and outside sales force. Innovative pumping solutions, which is 15 to 20% of our business, is where we remanufacture, fabricate, or manufacture modular pump skid packages. And we also do water and wastewater. And once again, I'll go deep dive into each of these segments later on. And then supply chain services is where we help manage our customers' indirect spend. So we're typically housed within our customer's facility. And we manage their storeroom, or we have vending machines on their floor. So that's supply chain services. You can see our end market mix, and once again, part of the story and part of the movement in the stock, and I'll explain it later on. But our oil and gas end market is our largest end market, but it used to be as high as 60-70% as a company based in Houston, Texas. And through our diversification efforts, we've taken it down to 20% or less. Predominantly in the U.S., but we do have a North American footprint in the U.S. and Canada, and with offices also in the Middle East or Dubai, which once again, I'll go a little bit into that later on if someone asks me a question about some current activity that we've got going on in that part of the world. LTM sales, $1.9 billion in sales, 213 of adjusted EBITDA, over 170 plus locations within service centers, with the rest being in IPS. And really, as Robert mentioned, also highly acquisitive. And so I'll go through that later today. The segments, this just gives you a view of each of the segments and their LTM performance. What you can see here is from a service center perspective, our largest segment, $1.3 billion in revenue and operating income of $188 million, or north of 14% operating income margins. And then you've got IPS at $360+ million in revenue and $65 million of operating income, or 17% operating income margins. And then supply chain services at $257 million in revenue and $21 million in operating income. Point being, and what's the takeaway here is IPS tends to be our higher margin business, and our more high touch business, as we call it. And then our service center business, which is the largest piece of our segment, is the largest kind of consistent performer at 14% operating income. You can see we like to give pictures to walk people through a pictorial so they can really feel what we do. But if you look there on my right, you can see a DXP Supercenter, and that's what we mean by a local market presence that we service through an inside and outside sales force. People per se don't necessarily come into our facilities. We do have walk-up business, but it's really having that local market presence in an industrial market across the U.S. that we service through inside and outside sales. And that outside sales is a technical sales force, and it is a consultative sale on the outside. And so you can see that we service that through what we call a branch or a service center. And then IPS, we have an example here, and this is hard to capture in pictures, but it's where we remanufacture, we do pump manufacturing, we do our water and wastewater project management and engineering. And what you specifically see here is a pump on a skid, or two pumps, excuse me, on a skid with pipes, valves, and controls and piping. Point being, it's very hands-on. It's where you're doing a lot of value-added work. And then here on the far right, closest to me, if you will, is supply chain services, where you can see we're housed in the customer's facility. We're barcoding and bin locking their inventory of their indirect spend. And so we're intimately tied to the customer because we're in their facility, usually in their ERP systems, and managing that indirect spend on their behalf. So slide 6 here walks you through part of the story. Back in 2014, DXP peaked out at about $1.5 billion in revenue, but 70% of our end market exposure was to oil and gas. And so, as everyone knows, the oil and gas market cycled in 15 and 16, and slowly started to rebound mid to late 17 and moved on from there. Well, once we went through that last cycle, we made a conscious effort as a company to diversify our end markets, and primarily doing that through acquisitions. We want every oil and gas dollar we can get, as we say, but we also wanted more dollars of other end markets. And so you fast forward to today, and this is as of 2024, but oil and gas is 23% of our end market exposure, with water and wastewater being closer to 10%, as well as some other end markets we decided to highlight there that we've had an emphasis or focus upon. And so you can see that that's been part of the story, and that's been part of the movement in the stock. I think people are starting to see that we've been executing upon what we've really been focused on really since 2014, but it's just started to take traction here more recently. This gives you a sense of our product mix. So we go to market through the 3 business segments, but we also support those 3 business segments through 5 strategic product categories, with rotating equipment or pumps being the largest product category, and then bearing and power transmission products, metalworking or what they call cutting tools, safety products and services, and then our catch-all categories, industrial supplies. And then you can see where we fall out and where we rank across those product categories, with once again, rotating equipment or pumps being the largest product category at 60%. It's also the roots of the company, and where we really differentiate ourselves, or where we really start to build our moat from our perspective, is around pumps. The company was originally founded as Southern Engine and Pump Company, and so it's at the roots and heart of what we do and where our differentiator lies. Here on slide 8, this just lays out our strategy and our financial goals. Each year, our CEO and chairman, challenges us to grow 10% organically and 10% through acquisitions. Now, we don't necessarily execute upon that every year. Sometimes it's more acquisitions than organic growth. But point being, those are our financial goals. And if we execute upon that, we'll typically double our business, mathematically every 4 years, but realistically every 5 to 7 years, we'll typically double our business. And that's pretty much what we've done, except for a few exceptions, with one of those being 14. And so that's why we kind of use that demarcation point here more recently. But from when he bought the business back in the late 80s, early 90s, we've essentially just doubled our business every 5 years. And we've been executed upon that. And so today, LTM at $1.9 billion, the way we look at it is $2 billion's in the bag. And how do we now go from $2 billion to $4 billion? And so that's really the focus in the energy and growth. On the right-hand side, what you can see is some of our more recent acquisitions, and you can see a heavy focus on water and wastewater. And so you can see that there on the right-hand side. Slide 9 here gives you a pictorial view of kind of our performance since 2020, or I guess since the COVID market, as they call it. And once again, you can see we doubled our business from a revenue perspective, over tripled our EBITDA, going from 59 million to 213 million LTM, and thus driving our returns, our return on invested capital in excess of 30+%. And so you can see that alongside with that, we increased our gross margins almost over 400 basis points and improved our EBITDA margins as well, nearly doubling them, if not a little bit more. And so you can see part of that's all been driven by not only the growth, but the diversification and the accretive nature of some of the acquisitions. So. Slide 10 here gives you a good pictorial of both EBITDA and cash flow. And why we highlight this is because we're a counter-cyclical, if you will, cash flow production type company, meaning when we're in growth mode, we actually produce a little bit less free cash flow, even though we're focused on increasing our free cash flow yield, if you will. But when the business cycles, we produce free cash flow in excess of 100%. That's important because when you look at our capital structure, we do finance ourselves partially from time to time with debt to accelerate our growth via acquisitions. Robert's correct. We can self-fund through typically our free cash flow, but when we want to get aggressive, our capital structure today is composed of an ABL plus a term loan B. And so we tap the institutional debt markets to grow. But why we can do that is because if the business cycles, we know we're going to throw off, a huge amount of free cash flow. And so this just gives you a pictorial of that. You can see in the COVID year, we produced over $100 million worth of free cash flow. And so what do we do with that? We opportunistically pay down the debt, let the market calm down, and then we turn around and go right back at it. So this just gives you a sense of our capital allocation over the years. The real takeaway here is you can see on the net share repurchases, we bought back over 4.4 million of shares here more recently due to the depressed stock value, and us being no different, I would say, than you guys. We want to support the stock. We want to invest in the business. And so we strategically, from time to time, bought back shares. And it's been an unprecedented amount of shares that we were able to buy back and drive some value creation for our shareholders. And that's really it. I'll stop there and open for any questions. In the appendix, and I have some presentations if people want to take a few copies later on. In the appendix, there's just a deep dive on each of the segments, so you can get more of a history of each of the segments here, whether service centers, IPS, or supply chain services. But would love to take it to questions.
Given your debt financing, how has that had, or has that had any impact with the changing interest rate environment?
Yeah, so for us, it's for me, it's been a positive. What do I mean by that? As a publicly traded company, when I go to the institutional debt markets, they're not going to allow me to get leverage above 3.5, 4 times if I'm lucky. versus my peers, which we do have some peers in the private equity space, they get 6 to 7 times leverage. And so what that's been able to do for us, from my perspective, is as interest rates moved here more recently and the interest rate environment got much higher, it was normal course for me. I was just servicing the debt contractually as we were supposed to, and able to go execute on acquisitions, versus I believe a lot of my private equity peers, if you will, from a competitive standpoint, were spending more time on debt service than anything else. So that gave us probably an opportunity or a leg up on some acquisitions at certain inflection points. And so I think that's why you see some of the push on the acquisition side. But they're always there. It's a inevitable piece of the landscape today. And so, but I think in this environment, I think it favors strategics a little bit more. So.
Yeah, I see you mentioned that you bought a lot of shares. The company started buying many shares, and I was looking. So the stock is DXPE.
Yes, sir.
NASDAQ. So I noticed the split with the reverse. Was that a reverse split or forward split?
I wasn't around then, so I don't have all the details, but the split was many moons ago. And so that was, I think even, gosh, I don't even know when the split was, to be honest.
It looked like they gave out shares because they were 2 for 1. So
yeah.
I think the company may be very good.
Yeah.
The charts that you showed us over time seem to rely and involve your company less and less in oil and gas markets. Is that a conscious choice or just a reflection of less involvement with fossil fuels as a whole?
I think it's, I think it's a conscious choice to diversify. But, so our IPS segment, 50% of it's oil and gas today. We're chasing every dollar we can get, every project we can get. So, so there's more brown projects, green projects, whatever you want to call them. And so, and even some of our more recent acquisitions, one of them has, in the Gulf Coast region, had oil and gas exposure. So I guess to answer your question, from our perspective, we still want every dollar we can get. We're just very sensitive or more conscious about being sure we're getting the water, wastewater, food and beverage, chemical, general industrial. And if we're going to look at those other acquisitions, the multiples are going to be on the lower end on the oil and gas side. So if that answers your question, we're seeing just as many projects in our minds as we saw before. The one theme I think I've talked to some people about already that we see is when the market cycled in 2015, 2016, there became this huge emphasis on return on capital with the majors and the mid majors and all that. And I don't think that ever went away once that kind of stuck. And so the spending from 17 onwards has been pretty consistent. So I know there's current volatility today in terms of what people are predicting in terms of oil prices, et cetera, and all that. And I, not that I would see it at this point in time, but I don't think that's going to change much of the activity that we see right now, because there's just been a more discipline around the capital project side, which we tend to service here more recently since, I think, really since 17. We've just had a steady flow. We report backlog numbers on an annual basis, and we provide color commentary on the quarters. And if you listen to us, what we've repeatedly kind of been saying over the past 2.5 years is that our oil and gas or energy related backlog has been steadily just increasing. And so it's been a very consistent activity from our perspective. Now here more recently, we've gotten some bigger projects. And so, those may taper back. And so you take those big wins, but net still the backlog's growing. So it's been a lot more consistent, if that answers your question.
So which of your divisions is most profitable, not in terms of just earnings, but in terms of net?
In terms of what?
Net.
That would still probably be IPS. IPS would still be the most profitable.
IPS standing for the pumping?
Innovative Pumping Solutions, yeah. And part of that's here more recently been driven also by the water, wastewater. So within that IPS umbrella, if you went back to 14, so almost 100% of IPS was oil and gas. You fast forward to today, almost 50, not quite, but just call it 50-50 is oil and gas or energy, and then water and wastewater. And that water and wastewater, you can have businesses that have 40-50% gross margins, and EBITDA margins in the 20+% range. And so that's really driving not just the sales growth, but also some of the profitability. So and we believe that water wastewater can be $1 billion business, and so that's our short-term to medium-term goal. And so today it's 150 to 175 million in terms of revenue. So there's a lot of runway to go there. So.
What do you think the biggest risks are facing your company?
Great question. It sounds cliche, but I would say people. We don't work in a very provocative industry. We're an old economy, blue collar industry at the end of the day. And I was talking to someone, as we get to this size, trying to find people who want to go work in this industry, whether either at corporate or in the field, is very challenging. It's not crypto, it's not Facebook, it's not social media. It's old economy, and it's B2B. It's necessary. It keeps the wheels of industry in motion, but it's not where people think to go. And so I'd say that's one of our biggest challenges. I'd say that's the biggest challenge. What we do day to day is not rocket science.
Any more questions for Kent? I'd like to ask a question, Kent, regarding your growth driver of M&A acquisitions. How does the landscape, how does the ramp look, and what industries will you be focusing on, say, the next couple of years?
Yeah. So one, Robert, on the last earnings call, we have a pretty full pipeline. So I mentioned we have 3 to 4 letters of intent. What I would say is that continues to remain the same, and we keep seeing more opportunities. That's also what's unique about our industry, to hit on the last issue from an acquisition standpoint. If you look at the history of the industry, industrial distribution, you have a lot of baby boomers who went into it, who used to work for the manufacturers. Well, if you fast forward to today, a lot of the baby boomers are, if not already at retirement age, are planning on retiring. And so you have this huge generational transfer occurring right in the moment. And so I don't suffer for acquisition opportunities, I guess is the point. So I wake up every day, and I've got an NDA or something to sign because I need to go filter and look at an opportunity. And so point being is we see tons of acquisition opportunities, and in the current moment, I'm probably in one of the sweetest spots I feel like I've ever been around the industry, and I've been around the industry pretty long. Second thing I would say to answer your question is obviously water, wastewater is a focus, but we're, in some senses, we're agnostic. Our CEO, David Little, has always said, there's probably over 300 plus industrial markets in the United States, and we're probably only in half of them, if that, today. And so there's a whole nother set of industrial markets we got to get into. And as we get in those markets, we'll get into different industries and pockets of the United States and of North America, if you will. And so that pie today will look much different 5 to 10 years from now. That's what I can assure you, if we execute upon our strategy. We like water, wastewater. We like all the dynamics that are behind that, given what we went through on the oil and gas side. But the reality is some of the companies we buy are just general industrial economy type companies. They could be paper, they could be agriculture, they could be just general industrial. And so we're really agnostic. And so people will see us execute upon acquisitions that, yes, could have a water, wastewater focus, but a lot of other focuses as well. So we like food and beverage. We like the things that we say that aren't going to go away, that people got to keep doing. and so we look for those things. Even the oil and gas, it's a depleting resource. We need it to keep doing what we're doing in today's world. And so we tend to like those markets because we can see those long term, and you can have a long term view on those things. So
they say lipstick is recession proof too, no matter how broke people get. they will buy makeup. You mentioned your last earnings call, so what did this year look like in terms of earnings, last couple of quarters?
So let me just kind of fast forward here, so I'll just walk you through it. So Q2 was a good quarter. It was a record quarter for us. It was at 499 million just in terms of sales, and then you can see adjusted EBITDA 57 million and 11.5% in terms of EBITDA margins. And so sometimes I do get that question of kind of over the short to medium term, where do we think we could take EBITDA margins? And you can see it. It's easily a 12 to 12.5% EBITDA margin business over the short to medium term. Now, some of that's going to depend upon mix and ebb and flow, but that's kind of how we look at it. You know, and so we're run right into the 2 billion that I referenced earlier. You can see return on invested capital is in excess of 30+%. And so, you know, we feel good. We do have some large projects. That's some of the quarterly commentary. We got 2 large projects on the IPS side. One of them is in the Middle East, in Dubai, and then the other one's more domestically based. But and so, but we get excited. That's where there's also opportunity. You know, the rest of the world, as they say, if you will, we've been primarily a North American and U.S. focused type company. But as we get bigger, and that's a challenge for us. That's one of the challenges is how do we start thinking about the rest of the world? And we have those opportunities. We did an acquisition, B27, many moons ago that got us access to the Middle East. And part of that is starting to pay dividends. We thought about closing that aspect of the acquisition initially, but we stayed with it. And today, that's really paying dividends. And we see that part of the world as being a piece of DXP that could be, you know, $100 million, $200 million business, frankly. So.
Okay, well, thank you, Kent, and thanks for joining us. Any closing comments?
No, excited. As our CEO always says, we still think we're undervalued, and there's still an overhang on our stock, but why wouldn't we say that? But no, we love it, and we think it's a great opportunity, and you know, our short to medium term goal is to double the business. So.
Terrific. Thank you very much, Kent.